This is the only day trading strategy I would use if I could go back in time and start over from scratch. And the best thing about this strategy is that you only need to use one simple indicator and price action. So guys, I really hope you will find value in this video, and without further ado, let's jump right into it. So the very first thing you want to do is to open up a clean chart in TradingView. Right now, as I'm speaking, I'm looking at gold on the 5-minute time frame. And the time frames I recommend for this strategy is either 1 minute, 5 minute, or 15-minute time frame. And before we take a look at the indicator you need for this strategy, we need to understand a few concepts. The first thing we need to understand is something called a failure test. A failure test is a move that happens frequently in markets, and to identify a failure test, we first need to identify a key level. And on this specific chart, on the 5-minute for gold, we can actually see that we have a very significant level here that has both been acting as resistance multiple times, right? So you can see resistance, the price pushed above the resistance, and we flipped the resistance to become support. So we can use our horizontal line here and draw a trend line, a horizontal line. And what we're looking out for here in this specific strategy is that we want the price to come down to a key level like we are seeing right here. And one thing we want to see here when the price goes down is that preferably we actually want to see a pretty strong move here down towards the level. In this case, we have a support level, but this trading strategy can be used for resistance levels as well. But the most important aspect here about the failure test is that we want to, let's zoom in here a bit, we want the price to dip below the support. You can see in this case, the price went just slightly below the support. And then we want the price to quickly shoot above the support area. This right here is what we call a failure test. So to identify a move like this is the first part of the strategy. But in order to make this strategy even better, we need to use our indicator. So we navigate up here to the indicators tab, and what we simply want to search for here is volume. And as you can see, we have tons of different volume indicators here in TradingView. But this strategy I want to keep as simple as possible, so we can actually use the normal volume indicator for this strategy. It works super well with the normal volume. And what we want to do here, let's once again zoom in on the candles. What we preferably want to see is that when we see the failure test, so this candle right here, we want to go down here and look at the volume. And let's zoom in here even more. We want to see the volume bar on the failure test, like you can see right here. We want this volume bar to be much higher than the previous volume bars. And as you can see in this case, the failure test came and we saw a massive spike in volume. And you can basically think about volume as how many buyers or sellers are supporting the move. So when we see a strong volume bar, when we have a green candle, you can think about this as that many buyers are supporting this failure test right here. So this strategy is very simple. We want a failure test, we want lots of volume. When we see these two signals, that is our entry point. And very soon in this video, I'm gonna show you guys another way to use this strategy. But first, let's take a look at, how to place the stop loss and how to set the target for the failure test. The stop loss is very straightforward. We want to place the stop loss below the lowest point of the failure test. So as you can see, the lowest point of the failure test is right here. So what we want to do is basically set the stop loss, a tiny bit below the lowest point of the wick of the green candle. And when it comes to your risk to reward ratio for the failure test, you can use a few different methods. One way is to simply use risk to reward ratio. A common one is a risk to reward ratio of 2 or a risk to reward ratio of 3 here. But what you also can do is that you can look for previous market structure. So in this case, we can, for example, see that we did have a few highs coming in right here, right? So we had a possible sort of resistance area right here. So what you can do is you can actually set your target just below the resistance area. You can see in this case we actually smashed above. You can see we saw a massive breakout above above that resistance. But this doesn't happen every time. This definitely doesn't happen every time. So many times it can be a better idea to, you know, look at the market structure and set your risk to reward ratio accordingly. But guys, I do want to take a look at another example of this strategy. We actually have a perfect example right here as well. And the reason I want to show you all this example right here is that this strategy can be used both as a reversal, but also, as we showed in the previous example, let's go back here, it can also be used as a continuation. So you can see right here, this is a continuation, a move in the same direction as the trade, right? But we can also use the failure test as a reversal. So let's take a look at this example right here. So let's take a close look right here. You can see that we have a clear low right here. And one could also argue that we had, you know, a massive sort of demand area. We can draw a sort of massive support area like this, because you can see the price came down. We saw a bounce here, the price came down. We saw massive demand coming in once again. And now the price is going down and we are seeing a failure test. And the very impressive thing about this failure test is look at the volume. You can see that on this green candle right here, you can see this green candle, we went below, we dipped far below the support. So we went very deep here. But during this candle, we had a strong volume bar and the candle shot up above the support, meaning that many buyers are supporting this massive reaction of the support. So this right here would be our entry signal. So we enter the long position at the candle close of the move, setting our stop loss once again below the lowest point of the candle, right? And as for your risk to reward, you can keep it simple and use a fixed ratio of, for example, 2:1, or you can look at previous market structure. In this case, we can clearly see that we have, you know, a resistance area somewhere around here. So for this example, having the target around here or just slightly below the gray area makes a lot of sense. Alright guys, so the indicator we used in this video was volume. And volume is a tool that can be useful in so many trading strategies. So if you have the time today, I highly recommend all of you to watch this video about volume next.